Okay, on today's show, 3 questions. Number 1, we're in the first sell-off of 2024. What do you need to know? Number 2, are student loans actually going to be forgiven this time? And number 3, do you feel rich? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Yo, guys, how are you?
I'm great.
Rabih, you feeling okay? Eyes okay?
All good, yeah.
You want to tell the people what? It's not allergies.
It's allergy season, and now we see the sun more. So I decided to put on some sunscreen this morning, and they went into my eyes, and I've been crying all day.
So we had 2 people crying in the office this morning before 9 a.m. Rabih was crying because he had sunscreen in his eyes. Victoria was crying because the new Taylor Swift double album came out last night.
My wife was listening to it up into the wee hours of the morning.
Yeah. Victoria came in with all sorts of emotions, ups, downs, sideways, just all over the place. It's going to be playing in our office for the next probably year. I have not listened to it yet, but I am looking forward to listening to it this weekend. So let's jump in. Rabih, we have officially hit a sell-off at least on the S&P, the U.S. market. What do we need to know?
Yeah, so I still remember like 2 weeks ago, we were having our quarter end episode, and we were saying, the U.S. stock market, whether it's the S&P 500 or the Russell 3000, in this case, they're the same, reached around 9.8%, 10% in a quarter. A 10% in a quarter is a really good return. And the market kind of decided that it wanted to take a breather right after we issued that episode. So as of March 28th, which was the high for the U.S. market, it has retracted down 5.24%, which puts the year-to-date performance of the U.S. market at around 4%. It's compound interest, so when it drops 5%, it doesn't leave you with 5% return. It actually leaves you with less. So looking at that, I know, Jake, we were talking about it earlier this week. Like, some clients are already reaching out. It's like, what is going on with the market? Can you guys talk about it a little bit? And yeah, of course we can. So I've got you some data to talk to you about.
Of course we can talk about it. Yeah.
I'd love to talk to you about why the market is down. So there are, I would say, 3 main themes that kind of explain what's happening with the market lately. 1, earnings seasons, which we're in. 2, the inflation narrative and the Fed. And 3, geopolitical risks. Geopolitical risks, we all know what's going on outside the US, and how that uncertainty actually makes commodity prices higher, aka oil and gas going higher, because when you're in a strained geopolitical regime, like terrain, that would become a more valuable commodity, especially when yielding a war. And that, for the US consumers, has an inflationary effect, because now we are competing for the oil as well, competing against other countries that they need more of it just to continue their wars. So that's from the geopolitical oil perspective. From the perspective of earnings, the earnings season just started. Out of the S&P 500, the S&P 500 has 500 companies in it. As of this week, so we're on April 19th, only 70 of them reported, mainly banks. So we don't really have the whole picture yet, but we've gotten some data. By the end of next week, another 160 will be added to those. So 3-4 weeks from now, we'll be done by earnings seasons, and we can talk about it more comprehensively. But for so far, out of these 70 companies, only 55.7% reported their revenues above analyst expectations. The long-term average, usually 62%, aka usually 62% of companies report above revenue analyst estimates. Only 55 this time, and over the past 4 quarters, it has been 65%. So it's like a 10% drop compared to previous quarters, which is gonna be reflected in the prices. The PE ratio for the S&P 500 was around 20.7%. Now we dropped back down 20.7 points. Now we dropped down to 19.9 points, simply because the prices are reflecting lower earnings. Another good estimate to talk about is that for Q1 2024, there have been 86 negative earning per share pre-announcement issued by S&P 500 companies, compared to only 29 earnings per share pre-announcements. And pre-announcements is just a tactic that companies use instead of having to surprise the market on the day of earning with like a really good result that outperforms a lot, or a result that really downperforms and would cause an overreaction because everyone would flock to trade at the same time. They would start leaking, or aka pre-announcing, what they think their earnings per share are and whether analysts are getting them right or not, just to avoid those spikes in their stock price and make the transition of the transition of transmitting this new information about their stock smoother. So earnings, while still robust, while still strong, are actually lower than last quarter's and the historical average, which the market is reflecting. And the last point, do you guys have anything before I move on?
Nope. You can.
Okay.
I do have a couple questions, but you can finish it out.
Okay, and the last theme, which is interest rates. We know, like we talked about it last week, like which developed country might gonna be cutting interest rates first. The U.S. will not be that person because the economy is too robust. The labor market is not being affected, and as we have seen, inflation has stagnated since the beginning of the year, and unemployment has stagnated since the beginning of the year. They're not heading in the direction that we would want them to move. So the Federal Reserve actually had it wasn't one of their official meetings, but Jerome Powell had a press conference, and we said that inflation is still too high, and if this means that we're going to stay higher for longer, we're going to stay higher for longer, because we do not want to repeat the mistakes of the 70s. And the market just needs to reflect now that, yes, the Fed might not do 3 rate cuts as they spoke. Goldman Sachs came out actually and said they don't see a cut until early 2025. So people now are hypothesizing for when the cut is going to happen. It's so funny. Like, the Fed has always said we have 3 cuts for this year, but now it might be less. We'll see in
Or
May.
none. It could
Or
be none.
none. Yes. We'll see in May when the Federal Reserve meets and what they're going to be saying. But from the market's perspective, it's so funny. I have a meme. I'll have to share with you guys. We started the year with the market pricing in 6 rate cuts, and now we're at like 2 to 1 cut, according to what the market thinks. If you look at the federal Fed funds rate, so it's a matter of just, here's how the economy is doing. The Fed has a plan. The market has expectations, and we're just reflecting it in the price up and down until we figure it out. So when you see that the markets for the past 2 weeks has dropped by 5.2%, which is, way so within the probabilities of what fluctuations should look like in the market. Like, this is so normal. You see that there is a strong economic narrative behind it that would justify it, that would remove away the noise, to just plug in the podcast, right? To navigate the noise about it. And yeah, here's where we stand, depending on how the economy evolves, depending on how geopolitical events evolve, and depending on how earnings season pan out, we would understand which direction the market would be heading next.
Yeah, just to that point, Rabih, for context, the S&P, if you look at historical data over the last 100 years, we have a 10% correction about as often as your birthday, right? About once a year. So it's a really normal cycle. We always say this is a feature, not a bug, these ups and downs. I'm curious, Rabih, sometimes I feel like some of this stuff happens and then we try to explain it later. We try to like add stories after the fact. How much do you think, we don't know, we're just speculating, we're just giving our, like our 2 cents. That was bad. But I'm wondering how much of this is just a natural sell-off, almost like a regression to the mean type of thing. Like, we had such an incredible first quarter. This is just a behavioral kind of response to that.
I was going to ask that. I mean, when was the last time we had a drop of 5%? It feels like last year it was a pretty steady, just up and to the right type movement. So it feels like it's been a while. It's almost like we needed a breath.
Totally. Yeah. How much of that do you think, Rabih, is just like, it just kind of naturally it happens again, kind of like this regression to the mean. It's like goes up for too long, and now it's like the market kind of reacts to that.
Yeah. The last time we had like that sell-off in that sense was August, September, October of last year, of 2023, and since then it's just been shooting upwards. The idea of reversion to the mean, while it's very intuitive to capture, is actually not accurate at all, because the market is the economy is continuously growing, the market is continuously growing, the mean of the value or the mean of the production is also changing,
It's
so you
always
are
moving,
changing
yeah.
to a new mean. So the idea that you have to sell off back to a certain level is not accurate. The hypotheses that describe why the market portrays such a behavior of like reversion back to the mean is called the rebalancing effect. And you would see this in most portfolios. So if you've had bonds, while they are yielding 5% on their coupons, their actual principal has dropped like 2% this year. So if you are in a portfolio that's 50% stocks, 50% bonds, and we're talking here across all people who have portfolios, the whole market, and they want to make sure that their portfolio stays in that risk measure, not now because equities have rallied and bonds remained where they are. Your portfolio transitioned from a 50-50 to a 60-40. You don't want that. You're exposing yourself to an additional equity risk that you didn't factor in. What you would do is that you'd rebalance your portfolio or sell out of the equities. This will make the equity market go down, and you would buy into the bonds, and that would make the bond prices go down. So go up. So the rebalancing effect, and this is evident mainly in fixed equity and fixed income markets, but the hypothesis can be expanded to equities. The rebalancing effect is a behavior that once looked at ex ante, like after the fact has happened, you can actually say, oh, it's reversing to the mean, we are taking a breather. But this is what is happening from a market's dynamics in the background.
Oh, ex ante. I haven't heard that since I was a trader. Since I was a trader at Fidelity, talking about dividends. Wow, that was also the nicest way I've ever had anyone tell me that was a dumb question. That was the nicest way.
No, you clarified a concept that's usually mistaken.
That was amazing. Jake, any thoughts on this? Any other comments?
No, as Rabih mentioned, I have gotten a few emails from clients just saying, hey, is there any explanation for this little market dip? Is there any reason to be concerned? I think what these election years, people just have a little heightened sense of nervousness and anxiety, I think, too, is naturally at the forefront to know, the different wars happening around. And, Rabih, you mentioned it, inflation's kind of sticking a little bit higher than we expected. I wonder how much of this is just corporations are like, we're not going to lower our prices. Like, they're just like, people are keep buying our stuff. We're going to keep our prices high. Anyway, I just think in these kind of more emotional election years, people tend to be a little more just heightened sense of volatility kind of around the markets and stuff. So I think the anxiousness is kind of a natural, normal response.
I think that's totally true. And then again, as you have what we've had over the last, basically since the end of 2022, right? For a solid over a year of just basically nothing but up. I just think there's this natural, as Rabih put it, rebalancing effect, or just kind of this readjustment in the market, again, that happens all the time. It is so normal. So if we're talking about literally navigating the noise, truly, like the data shows, you're going to see a 10% correction every year.
I think a 5% drop happens like almost every single year. Like you will not have a stock market investing year without a 5% dip. So this is our first one this year. It's never fun to see your portfolio go down, but very normal.
Yep. And this is the price you pay to have the return. Like, without this, there is no return. This is the uncertainty is what you have to take on to have the long-term growth and gain. So Rabih, any other final thoughts on that? So you mentioned inflation. This actually relates to the second topic, which is student loans. So the question being, are student loans actually going to be forgiven this time? And there's a lot of talk around the second order effects of this, of if this does go through, what could that do to inflation? And it's possible. I would imagine that Jay Powell, as we know and love him, is probably it's very possible he's considering these things when it comes to the things happening on Capitol Hill with Biden and the administration, and what second order effects could be there, which could possibly lead to them. They're probably looking at data. I mean, obviously they're looking at data, but I'd imagine they're also looking ahead and saying what things are getting put in place at the legislative level, and how is that going to impact this, which might mean they're lowering the impact, or lowering the probability of raising rate or lowering rates again, right? So with all that said, Biden has come out again. He's actually, all reports are like he's trying to push this through very quickly. Surprise, surprise, it's an election year. He's trying to push something through that I think would win him a lot of votes. And surprise, surprise, the other side is trying to stop him again. So just to give some highlights of this, we talked a little bit before this. This came out like 2 days ago. So Jake, you were mentioning you hadn't really seen much on this yet. Rabih, you hadn't seen much on this yet. I just pulled this up like yesterday and then was reviewing it more this morning. But just for some highlights, they're saying, again, a new proposal to go along with SAVE that's already in place. They're projecting could be up to student loan forgiveness for up to 25. They're saying up to 30 million possible borrowers that this could have an impact on. A couple of highlights here to hit. So what they're saying is there's kind of two paths to get any level of relief here. So they're saying borrowers could qualify for automatic loan forgiveness up to $20,000. And this is an exact quote from the report. If borrowers' loans currently exceed what they owed upon starting repayment. Yep. So basically, if their loans have ballooned because of interest, they would be automatically qualifying. I don't even think they have to like apply for this. It just like happens. They get $20,000 in relief. They are saying additional borrowers could get complete forgiveness of accrued or capitalized interest if the borrower is enrolled in income-driven repayment plan like SAVE. And they also have to be below certain income.
Under certain income
limits. Certain income limits. So if you are a single filer, you have to be making $120,000 or less. If you are a joint filer, you have to be making $240,000 or less. So I'll stop there for a second. Jake or Rabih, any thoughts at all on this?
So it seems to me like the idea here, right, is what they want to do is just for all of these people out there, which Matt, you mentioned, what it looks like here is the Biden administration has said that there's over 25 million Americans whose student loans are now more than what they ended school with. Like they have accrued interest on top. And so they are trying to help out these people. So they're saying, yeah, if you, like everyone's eligible for up to $20,000. And then if you make under certain income amounts, you can get all of your capitalized or accrued interest forgiven. This is kind of the same thing as the SAVE plan, right? The SAVE plan essentially does this for new borrowers. If you're getting on the SAVE plan right now, graduating school right now, you are not accruing interest on your loans. Well, it looks like what they're trying to do is to almost apply the SAVE plan benefits to past borrowers.
Exactly. Yep.
So I don't know. I mean, it sounds, if you have student loans, it sounds like a great deal there.
It sounds amazing. Yeah.
Will this get passed? I have no idea. It feels like no. It feels like there's enough like tailwind against this last time. I mean, headwinds against this like last time that there's just going to be plenty of states and people out there who are opposing this.
Yeah.
I don't know.
I would agree too. Rabih, do you have any thoughts?
I'm just thinking of it from like a macro perspective. So now student loans retrospectively have always been a zero interest rate loan. Like
essentially, that's what happened.
Basically.
Trying to get to.
Yeah.
So
except for the people who paid off their loans already. Those poor people.
Exactly.
Those poor people, I know, seriously.
Yeah. But while I'm not discrediting the benefit it would actually make to someone's life to take those loans away, from a systems perspective, that might not be efficient, because now then how about I go take a student loan and instead of using it for education, I just put it in the market and I just got a 0% loan and I'm being able to buy a house, for example, with it. So there's this no arbitrage principle that actually governs markets and makes prices efficient. And you would want it to stay there and not have one type of loan allow you to have this arbitrage opportunity.
Yeah, well, I think one of the biggest issues, in my opinion, on this, and I've heard this thrown out there before, and I'm trying to think of how it doesn't make sense intuitively. Maybe I'm missing something. You guys can tell me here if it doesn't make sense. But I think a very simple solution here, because I think, to back up, I think the biggest issue everyone can agree on is that student loans have gotten out of control. The cost of school has gotten out of control. I think we all can agree there. It's kind of like we're going to teeter on the edge of political here, getting political. But I think it's kind of similar to the healthcare system. I think everyone can agree the healthcare system in America is flawed, right? I think everyone agrees with that. I think where we disagree a lot of times, people in general, both sides, I think is how we fix it. And I think the same thing is with student loans. I think everyone can agree the cost of school has gotten out of control. To me, I heard this on a podcast a while back, and it seems so simple. I think the mechanism to fix this is to allow student loans to be forgiven in bankruptcy, just like any other loan. Because the problem right now with student loans, and I think one of the main reasons why this runaway inflation within student loans over the last 20 years is because what is the risk to the lender of giving out these loans? None. What's the risk of them continuing to jack up prices, schools to jack up prices?
That's what the schools, universities keep charging more.
Why wouldn't they? Why wouldn't they? Because there is no limit and there is no risk to the lenders. When a lender's giving out a loan in the traditional sense, let's say business, home, whatever it is, they're assessing the risk to them of giving you that money. There is no mechanism of risk assessment required when it comes to student loans because they can't go away. They're not going away. So to me, it seems like a relatively simple solution. Just allow them to be written off if like any other debt. I've never understood that. I guess, what are your guys' thoughts on that, if any?
That makes sense. I'm not an economist. One like macroeconomic thought that I had though was, I know most surveys now, most Americans' number one like issue or concern is inflation, right? That's like at the top of most people's list. People hate when the things they're buying cost more. And I know like people think, hey, forgiving student loans is helping people. But isn't forgiving student loans and a lot of this debt essentially pumping more money into the economy and then causing just inflation to go up? Like, isn't this kind of contributing to the fact that most people are most stressed about? Am I thinking about that right?
So there's a lot of reports about this, Jake. I'd mentioned at the very beginning of this part of the segment that there's a lot of reports out now talking about inflation and the impact this could have on inflation. Truly, if 25, 30 million people have $20,000, forgiven, that they no longer have to pay. I would imagine the second order effect there is you just keep driving inflation, or at least keep inflation steady where it is.
You're essentially pumping hundreds of millions of dollars back into the economy, which is this increasing inflation. Yeah.
Because let's be real, people, especially Americans, this is backed up by data, are not great savers. Right. And so those people in general, I'm guessing, are not going to, if you just think about it, and again, based on data, they're not going to be like, you know what? I want to go ahead and save this money. I'm going to go ahead and invest this in a brokerage account. Most of these people are just going to go spend it. And so to that point, I can imagine that, driving inflation up. Rabih, what are your thoughts on any of this?
I agree with both of you. The thing I'd like to highlight is, this separation between the person making the return and the person taking the risk is what is allowed. Like, even if you forgave all student loans due to a bankruptcy, like you allow this to happen, the infrastructure that allowed it to become the problem would still be the same. The idea is that colleges, no matter what the degree is and whether it's relevant to the economy these days or not, are going to be offering it and charging high tuition for it. And they do not care whether you as a student will be successful once you graduate or not.
No incentive there.
The bank wants you to be successful more than your university wants you to be successful, because the bank wants their money back. So the idea is, instead of actually taking the student loan and having to repay it for the bank, if you take the student loan and have to repay it back to the university you're studying at, the university might have a better incentive to actually form curricula that actually produce students that are productive in the workforce. So, or else we're just gonna click the reset button and repeat what we've done. So
yeah, I mean, to your point, Rabih, the fact that all degrees cost the same at all universities, like, you mean one university, whether
that is interesting.
Whether you're getting a STEM degree, right, that is so directly related to, like, it's so obvious of what that's going to turn into from an economic standpoint, to underwater basket weaving. Like, the fact that, like, they are the same cost is kind of insane at this point. I talked to a dentist actually relatively recent whose child graduated with a creative writing degree and spent $300,000. And it's like, come on, like that's kind of insane. So it's stuff like that I'm like, we've got to get more nuanced and maybe have more of a common sense approach to this moving forward. I think the forgiveness could possibly solve some things, but I think it's probably putting a Band-Aid over a far larger wound, right? So anyway, any final thoughts on any of this? Okay. Let's finish up with the last one, Jake. The question being, do you feel rich?
Yeah, this is great. Speaking of Biden, I feel like we've been talking a lot of, political plans and tax plans here. So there's an article from the Wall Street Journal that came out this past week where they interviewed a few people who are making over $400,000 of income, households that are making over $400,000 in income. The reason why this $400,000 mark is so special is in a lot of Biden's tax plans and policies moving forward, he's really wanting to tax the people making above $400,000. That's kind of the line in the sand that he's put in the tax code, essentially saying if you make above this amount of money, we are considering you rich. We feel like we can tax you a little bit more.
Which we have a lot, pretty much all our clients, right? A lot of our clients.
Applies to a lot of dentists, hopefully. Yeah, a lot of our dentists there. And so what they were doing is they essentially interviewed these people and said, okay, do you think that is fair? Does this make sense to you? Do you feel rich as someone who makes $400,000 plus in income every year? Do you feel like you're rich, and do you feel like you can afford to be taxed more? You can probably guess what the response was from the people in this article. They're like, heck no.
Yeah, unequivocally, no, I am not rich.
I do not want to be taxed more.
Do you want to be taxed more?
Exactly.
Yes, I do. Please do.
Before I get into the data, I wanted to share with you guys a few quotes from this article that I thought were just very interesting. So here's one from a guy who lives in California who makes over $400,000 a year. He said, I don't think of myself as rich. I think of myself as having worked really hard. I just found that is a fascinating way to frame it, where there's almost like this negative connotation when they're asking you if you're rich. I feel like people almost get offended by that question. It's almost like you feel like you're implying that you got lucky or something. I just found it interesting that he wanted to reiterate, no, I worked really hard for this.
You may have also gotten a little lucky too, and that's okay.
You have to.
Any successful person has to attribute some to luck.
Mm-hmm. And then anyway, there's a lot of quotes here too about people saying I don't have country club memberships. I don't feel like I live high end, but all these households making $400,000. All of them said I don't feel upper middle class. I don't feel like I'm part of the rich thing, which just brought my mind back to being does anyone feel like they're rich? This is a common thing. I don't know if you see this. You ask anyone who makes a lot of money, and most people would be like, I feel okay. I feel fine. I don't feel extravagantly wealthy. But the data will kind of disprove this sentiment. So what they share here in this article, they have a breakdown of all the people in America every household who makes over $400,000. So this could be spouses combined income,
family income.
Do you guys have a guess of what the percentage would be? How many Americans are making over 400,000?
Oh, it's got to be less than 5%.
Rabih?
Yeah, I agree.
It's 2.6% of households make over $400,000 for the year. This has grown recently. That's up 33% from 2019. So again, wages are kind of growing pretty proportionally. This has gotten a lot higher. It was under 2% in 2019. Now it's at 2.6%. The highest state. Any guesses on what state has the most people above $400,000?
It's got to be California.
California or New York.
It's actually Washington, D.C. is the highest, 6%, over 6%.
That says a lot.
All the government officials.
Washington, D.C. The highest ones are Massachusetts, Connecticut, New York, New Jersey, California, Washington. Those are kind of the top 7. Those are 3% plus.
Somehow all the people in D.C. that are pushing for this, that are making that amount of money, will find some level of exemption, I'm sure.
Guesses on the state that has the lowest amount of people making $400,000 a year?
Ooh, I don't want to offend anybody.
Alaska.
Not Alaska. Alaska's pretty good. It's Mississippi. Wow. Mississippi is actually the only state where it's under 1%. Only 0.7% of people in Mississippi are making over $400,000. But anyway, most of the states are around that 1% to 2% range. Okay. So this is just, I think it's so funny how we think about money. And we talk about this all the time, how wealth is relative and it's all compared to our peers. But just hearing from all these people in this article are being I don't feel rich. I don't feel rich. I don't feel rich. When the data says if you make over $400,000 as a household, you are objectively in the top 2% of Americans, which I would say is rich. If you're in the top 2% of anything, I think that's kind of, you're unique there. So I don't know. It's just this weird psychology thing that we talk about all the time where we can give you data and I can even share this podcast, but still people out there who are listening to this making over that are yeah, I get that, but my neighbor bought a new boat and I feel like I'm less rich than him, right? I don't know if you guys have thoughts about that.
No, we've talked about this so much and you already hit one of them. I think the two main points here, you already hit one of them, which is wealth is all relative, right? Wealth is completely relative. There is no objective form of wealth because depending on who you're comparing yourself to, we said this, I think last week or the week before, on this show, said the poorest person in the Hamptons feels worse than the richest person in an average neighborhood. And study after study after study backs this up. That you'd rather, people would rather be richer compared to, like, live in an average neighborhood but be richer than their peers than live in a rich neighborhood and be poorer than their peers. Like, this has been backed up by data because we're all comparison status chasing creatures. And I think so these people that are saying, I make 400 grand a year, but I don't feel rich, I feel normal. It's like, well, yeah, because you probably are normal or maybe even below normal in your peer group, I'm guessing, or the neighborhood you live in or whatever.
Yeah.
I think the other part of this is we've referred to this before, but it's the psychological term called hedonic adaptation. Basically, for better or for worse, our brains adapt, right? Again, for better or for worse. So in situations, basically a lot of data backs this up. Situations are never as bad as you think and never as good as you think. Your body and brain just adapt. So when you start to make a lot of money, you start to get used to it, and then it starts to feel normal. So I think, again, I don't blame these people that are making this money and being like, I'm just normal. It's like, again, because you've adapted to that. So I think it's totally normal to feel this way. But if you look at the data, to your point, Jake, you're in the top 2%. You are rich.
You're doing pretty well.
Yeah.
It's these weird things too. I think Morgan Housel has talked about this, where this is like how capitalism keeps churning on and how we have all these kind of psychological issues around money. The act of making money feels better than having it is kind of an interesting thing too, right? The growth, like we love seeing the income numbers go up and the bank accounts go up almost more than actually having the money, right? The quest to making $1 million feels a lot better than actually having $1 million. Because Matt, to your point, we just adapt. Once we have the million, it's like, oh yeah, it's just $1 million, and now I'm on to the, moving on to the next thing. But it's just interesting. It's kind of Carl Richards, I think, has said this once. I think about it all the time, where he's like, it's an interesting, our capitalistic and wealth building game here. It's an interesting game when the people who are winning the game don't feel great. There might be a problem with the game type of thing there. It's really interesting.
Well, I think it depends on what game you're playing, right? We've also talked about this concept. There's the game of status and there's the game of wealth. The game of status is a never-ending zero-sum game, right? You can't both win. Like, Jake, you and I can't win equally the status game. It's a hierarchical game. But the wealth game, we can all win that game. So I think it all comes back to, like, I think intuitively we all know this. We all talk about this, like the whole idea of like money can't buy happiness. Like, this is an intuitive thing, but yet we all get wrapped up in it all the time. Yeah. So I want to get Rabih in here. Rabih, what are you seem to be ruminating on this.
Yeah, I like where you guys are going through it, but I want to take the position of one of our dentist clients who are making over 400K and they still don't feel rich. And we looked at it comparatively, like looking at the data, compared to the others, you are in the top tier, so you should stop, I don't know, nagging about it in a sense. But this is the term, I think this is new, like in social media terms, but now we have dinks and we have Henrys and etc. And I'm thinking of people who are like Henrys, high earners, not rich yet, right? And this applies to most of our clients. Like, they are making a lot of money and in the 400K bracket, but they also have so many expenses, especially that they come up with. They're starting from a position where their net worth is possibly negative, right? So for those people, yes, they are top 2% compared to all of the rest of the US, but they have a much longer way to cover before they feel financially secure than the person who might be in the top 70%, but do not have student loans and they don't have practice loans, etc. So being a high earner does not mean that you are rich. This is what I might be wanting to like raise as an opinion, just because it's much bigger than that. And your feeling about how rich you're going to be does not only depend on the top line number you're generating, but actually the bottom line number of your net worth.
Well, and that's a great point, Rabih. And I also think along those same lines, we should be fair to the side of, again, we work with hundreds of dentists. The average income of our dentists is over $400,000. So we work with this demographic, right? And I think I can completely understand the stance from, let's again say specifically a dentist who's making this kind of money, who's probably sitting there thinking, because let's be real, the narrative out there around this is like, you should be paying more, right? Like, this is what this is the whole idea of Biden's proposal is you make more money, so you should be paying more than everyone else. And I think from a dentist perspective, is there the kind of like goes along that comment you referenced earlier, Jake. The dentist is thinking, wait a second, I took on mountains of debt. I spent 4 years post-grad. I have built a practice. I employ 15 people. Like, I'm stressed out of my mind every single day. Yeah, I make more money than most people, but I also have taken on it's kind of what you're saying, Rabih. Like, I've taken on way more risk, responsibility. Like, I've grinded to get here. I'm empathetic to that situation. I totally understand that. For them to say, why are you coming after me as if I should, like, I'm evil, or I should be paying more money than everyone else, a higher percentage than everyone else. Like, I understand that position 100%.
Oh, I agree 100%. Yeah, and I can see how it can be demotivatonomically, right, for these people where it's like, I took on all this work, and now as I get up to these higher income levels, you're just going to take more of my money from me.
Yeah, not only is school astronomically more expensive, and now when I grind and get through this situation with a negative net worth for years, and I'm looking at all my peers grow and their income earlier and their wealth earlier, to Robbie's point, their actual net worth, and now I finally reach the top of the mountain, or I'm reaching the top of the mountain and making more money, and now all of a sudden you want to start taxing me more. Like, I get that. That would be super frustrating.
Yep.
So, Rabih, any final thoughts?
Yeah, I find it, because now we're something that flashed my mind. Like, the same people who might be taxed more, right, are the people who might have some, favorable treatment regarding their student loans. So it's balancing out in a sense, right? It's not like the person who got that what did you call it, underwater basket weaving degree is the person who's getting the relief from their student loans, but the dentist is the only one who's paying the taxes. It's actually the person with the student underwater basket weaving. I love that sentence, underwater basket weaving.
No shade to the people who love doing that. No shade.
No, if you do underwater basket weaving, that's freaking dope. That's awesome.
That's fine. I don't think those people are gonna get taxed or get an exemption off their student loans, but the dentists who are on the top side of it will get both of them.
Yeah.
So
it's a double whammy. It's a good point.
So you lose some, you win some, and at the end of the day, it's fine if you stick to the plan where you're actually putting yourself towards getting to a better financial position and like financial independence position. Whether those happen or not, it's more important that you are actually doing something about it.
Yeah, but it is stuff like this, right, where to your point, Jake, demotivating, where we get questions from younger dentists, especially, of like, is dentistry still a viable career? Because of, I think this kind of stuff adds to it.
Yeah.
Not only the cost of school, but like everything happening in the corporate dentist, like DSO space. And now this kind of stuff with, people trying to, and who knows, I don't think it's going to get passed. But, if you look at historically, since pretty much the, I think 70s or 80s, tax rates have done, in fact, even further back than that, tax rates have done nothing but come down since like the 50s even. So I don't think that's necessarily going to, it's really, really, really hard to increase taxes in America. So I don't think it's going to happen, but I do understand the angst around it. Cause I would imagine dentists in general, I've heard this from so many dentists where it's like, people look at me like I'm some rich dentist. Like, I make all this money. And again, they just feel like normal people in a lot of ways. They are, they've just, so I totally get that. Jake, final thoughts.
My last point on the flip side, I agree 100% with what you're saying. Yeah, we're empathetic to that because we work with a lot of dentists. My last, maybe more optimistic point would be, if you are one of these dentists making over that amount of money, you feel like, you're maybe not quite getting ahead. There's a lot of people who have switched places with you. I would gladly get up into this 400K plus range and pay all the taxes, because you're still going to be in a better position than someone making $50,000 a year.
And to double down on that, from an optimistic standpoint, dentistry is still very much a viable career.
Oh, yes.
We have,
I would say yes,
100% confidence in that from what we see. It's still very, very much a viable career. So, all right, guys, Rabih, any final words? All right. Awesome show. Thank you, Jake. Thank you, Rabih. We're going to do another plug for the Dentist Money Summit coming up. We're like 2 months out, guys. It is coming up so quick. We are so excited. Check it out, dentistmoneysummit.com. For now, that's our 2 cents. There's only one thing left to do. Go forth and live your rich life. Bye-bye.